Hello and welcome to KYC. You are watching NDTV Profit and I am Sharad Dubey, giving you a season's greetings also as we wrap up the KYC season as well, at least for 2025. But there are important companies lined up before the year finishes. But before that, I would like you to guess the company which we'll be discussing today. So there are some hints I will be giving you. Of course, the company is a recently listed hospital company. Also, looking at another hint is that it's the second largest private hospital chain in North India and largest in Haryana. Interestingly, two of the biggest stalwarts in the markets, one is Vikas Khemani, another is Sunil Singhania. Their promoted entities, Abacus and Carnelian, have been investors. They have been the anchor investors. So I would be understanding as why are these astute investors coming in the small cap company, which is a hospital chain based in Haryana. And the company in focus is your Park Medi World. This is the company. Recently, the company was listed, and we will be getting you more details about this as we go ahead. So there are some questions I need to ask. Why I'm calling this company in my show right now? It's just recently listed. Why? First question is, the business model is a bit different for this company. They are acquiring a lot of companies and then they are streamlining their operations. Now, will this model actually work? That's something I would like to watch out for. Second, the operational trend outlook for 2026. Whenever you are judging a hospital company, average revenue per bed, the occupancy levels, everything needs to be checked. So that's something which I would be liking to know about this company. What's the progress of Park Medicity? There was, of course, some IPO proceeds also being used in this, but we want to know the timelines because these projects generally have a higher gestation period, and that's where most of the hospital stocks get hurt. The margin profile guidance. What is the blended margin profile guidance of the company? That's what I'll be interested to know from the management. And also importantly, I would be asking the overall growth outlook ahead. It's a newly listed company, untracked by most analysts, but I'll be getting you all the details about this. But let's see what the company is all about. That's very much important before we go into it. I spoke about the company that it is the second largest private hospital chain in northern India. Specifically, if you look at Haryana, it is having the biggest play there. Aggregate bed capacity, 3,250 beds. That you could say is kind of a small base compared to its peers in the hospital space. Also looking at that, 14 NABH credited multi-super specialty hospitals are also there, and it's under the Park brand. Now, whenever we speak about the multi-specialty areas, that is where the higher margin business starts coming in. And also there is a good amount of customer stickiness, but I'll give you all those details later in the show. Now, the offer is there for almost 30 super specialty and the specialty related services also. So the entire hospital theme is there and some ancillary services are there, but they are not that high as we look at the revenue contribution. This operational beds we spoke about, it's 3,000 odd plus, and other operational highlights also we look at it. The occupancies, it is not convincing. It is 68%, and generally there is a lumpiness coming in, but in an average industry 70 to 80 odd percent. So we'll look into this occupancy, at least the outlook from the management. ARPOB, you must be wondering what is this? This is average revenue per bed. That's what we look at, and this is the full form for it. And if you look at it, this largely has been decent as per the industry standards. But let's see the breakup of the revenue, how it's actually panning out. And you see, there is no concentration risk as such, 29 odd percent for internal medicine, but it's evenly distributed. And that's what I like about this breakup. And this is actually showing that there's no major concentration, and that's a good, you could say, a view for me in this revenue mix coming in. Also, apart from this, let's look at the trend, how it's actually panned out, and this is very much important when you see it. It's around 24,000. It has plateaued, you could say, but a slight increase is there. It's not, you could say that, industry beating numbers, but it's decent growth coming in. But we'll get into more details in the operational setup as we move ahead. Let's see other operational numbers if it's there for Park Medi. And apart from, okay, so after average revenue per bed, there is another important criteria, which is the KYC ratings. In our show, we have 8 ratings which we focus on, and I'd like to come and see which are those 8 ratings and how we judge a company in KYC. Of course, the financials is very much important. So you are having income statement, you are having balance sheet, you are also having cash flow and returns where we judge the company. Also, the company is having a very, very limited history because it was recently listed, but still we will see and judge shareholding, the street kit, how much it has reacted from its IPO listing price, what's the valuation against its peers. That's something which you'll look out for. And the outlook, this is very important because it's newly listed. The street really wants to know, the analysts also want to know, and even the DIs, PMS, AIFs who are listening to our show, they also want to know what's the outlook going ahead. So that is something which we'll be looking out for. 8 parameters, we'll start judging the company. Okay, so let's start the first parameter, and income statement is something which I have picked up, and my concern starts coming in. Not in these numbers, my concern starts coming in here. The 3-year CAGR numbers. Of course, we will get you the H1 numbers also, but over here it's a 4% growth. EBITDA just 3%, net profit 2%. Now my concern comes is, why is the company coming for an IPO if the entire huge growth numbers are not there? And their IPO proceeds also largely it has been for medical equipments and more expansion going ahead. But let's see whether the tide turns or not, and there it turns a bit. Why? The September numbers comes in, and that's where my interest comes in the stock. Revenue is up 17%, that's decent. EBITDA 14%, not much to expect, but the company somehow has managed to keep its margins, slight dip, but nevertheless it's decent 27%, and that's what gives me assurance when I'm judging this company. And net profit is also done up decently. So H1 numbers, they do really well as compared to the last 3 years number. But the question is, will this history repeat in H2? That is where my concern also comes, and that's what we'll be asking the management. Can they sustain it? If they sustain it, the numbers would be really strong. So from my side, income statement, 2 school of thoughts, I'll give a neutral rating. But after income statement comes the balance sheet. That's also very much important, especially when you have an asset heavy business model where you also have EV EBITDA multiples, price to earnings multiple. When you judge a company like that, that is where it's very much important, because the pressure comes when a company expands on the return ratios, and that will come later. Balance sheet, largely we see the book values has been decent. The borrowing, nothing has come down actually yet. It was 622 odd crore rupees in FY25. We thought that some IPO proceeds might be used for debt reduction, but it hasn't been used. It's 635 crores right now. And a little bit of concern coming in for me is that the liquidity ratios might be on the lower side, 361 crores in FY25, and it's going down at almost 164 odd crore rupees. Now it will be, of course, a challenge for the company to manage their working capital ratios as well as they are going across expansions. And some days ago, they announced another acquisition of 51 odd crore rupees. So is the company announcing a lot of acquisitions very fast? If that happens, then there'll be a strain on the balance sheet, and that's where my concern comes, and that's why I'm still giving just a neutral rating, and still it's a benefit of doubt rating coming in because the company has a very limited history. Also, apart from this, let's see the cash flow, how it's important. And cash flow is something which I had given you a hint in my last rating that working capital issues will be impacted, and look at this. It has been impacted. Minus 49 odd crore rupees. And the cash flow conversion to PAT, that has also gone down. Earlier it was, there were some aberrations in FY24, which we of course saw it in RHP, and I'm repeating it again. But the concern is coming here in September 25. Now the company has a challenge to overcome this. Right now it's in a challenging position. So it's a big thumbs down for cash flows when it comes to the company. Also, apart from cash flows, let's move on and see the return ratios. Now, of course, when cash flows are under pressure, balance sheet, I raised concerns. That means your return ratios will be difficult. Difficult as in on the lower side. Let's see how actually the return ratios are panning out. And whenever you're actually investing in this kind of businesses, you really expect 15 to 20 odd percent ROC numbers, return on capital to come. But then from FY23, there has been a gradual decline, and now it's below the 10% mark. And now, will this pressure sustain in H2 or even FY26? That's what we want to know, because if this pressure needs to bottom out, we need to see some more liquidity coming in. But company is in an expansion phase, and whenever hospitals have that expansion phase, it can last from 6 months to as high as 24 to 36 months as well. And that is where the concern comes in for investors. And if you're studying these type of models, it's very much important to have ROC also in your view. So for that specific analysis, I'm going to give a strong thumbs down when it comes to the return ratios or the return on capital employed. Apart from that, let's look at the shareholding. And shareholding I had mentioned earlier, Wall Street wizards, Carnelian and Abacus Group, they have invested in the company. That means they are looking at something which the company can deliver, maybe a regional play or maybe a company which is not noticed by the markets yet, and there is some kind of up move left. And right now we see the promoters are still holding a 83% stake in the company. Then in the next 3 years, we can see some promoter sales happening as per SEBI's minimum shareholding norms. So very low participation from FIs, but the magic lies here, the DIs, the AIFs, the PMSs, that's where they are holding, and largely they are expecting a larger alpha to come. So I'll be looking at DIs right now, and once the company gets bigger in size, then the larger PE VCs from foreign might come in. But net, I'll still give a neutral rating when it comes to the shareholding pattern. Also, let's look at the street cred, and I'll mention you that from the IPO price itself, nothing has moved. So in case if you have missed out on the IPO, maybe you can have a look at the company, but from the IPO price, the stock is down 12%, and from the listing price also, the stock is down 8%. Of course, there are market sentiments also which might have impacted, which we saw in the mid cap, small caps, and at times these counters go unnoticed, and that's my job to get you on our KYC show these types of stocks where there might be alpha in the future. But right now, on the current basis, I will be giving this company a neutral rating when it comes to the street cred or the stock price movement which has happened. Also, now let's look at the valuations. Now, whenever there is so much pressure happening in a hospital business, which is already having a premium, and do remember, hospital is a defensive play. So whenever there's a volatility in the market, we see a lot of institutions, HNIs lapping up hospital stocks. That's why they are always, premium valued in most of the times. Park Medi, I took out the trailing 12 months P, and it's at 27 times. Now I'm wondering why the company is not getting the valuations which a hospital stock gets, or is it underlooked right now? That's the question I'm raising. KIMS is at 65 times, and even Yatharth Hospital, that's at 47 times. So that makes this company actually very cheap if you compare it to the peers. And the larger peers, Fortis Healthcare is having 84 times, Global Health, which is Medanta, that's at 55 times. So there is a clear mispricing in the asset in the market. And maybe if that's the case, then it might be an important to look into, especially on the valuations front. But remember, the company is going through a lot of expansion, and these expansions take time. The cash flows which come in the P&L, the balance sheet, they also take time. So if you're a long-term investor, maybe then have a look in this. But right now, for the valuations which are looking mouth-watering, I would be giving this a strong thumbs up when it comes to the valuations front. But 7 important things we have spoken about. But the most important is the outlook. Everybody will be looking at that, and largely the company hasn't shared much information. Only the IPO time they had spoken about this. But I want to know something much more into it. Especially, let's have the question. They have acquired Febris Multi-Specialty Hospital for 51 crore rupees, but it's largely on the lower margin side as per my analysis. So I'll be asking this: why are they acquiring so many companies, and that's on the low margin front? That's going to, of course, give a pain balance sheet also in the future. The future acquisition and expansion plans, almost 50% of the revenue is just coming from acquisition. So company has become literally a Thrasio model kind of a play. The operational trend outlook for 2026, this is very much important, because operations also help us derive how the valuations can actually look going ahead. The progress of Park Medicity, that's one of their important projects, and they had taken the IPO money from that. So what is happening here? Give us the timeline. That's what the investors want to know. The margins outlook and the product mix, is this going to change? Because there's so many products here, and there is no kind of a concentration here. So we want to know the blended margin, where the things will actually pan out. Apart from this, looking at the outlooks, these are the important ratings which we have actually gathered in, and I would like to get you in minutely understand both of them, income statement and balance sheet. Let's give them some more time. I have given a neutral rating for it, but cash flows and return ratios, a strong thumbs down coming in. The company needs to perform, and if that pressure comes in, the pressure will come here as well. That's one of the biggest concerns. But let's look into the future. What's more important apart from the other rating parameters? The shareholding street credit, I've given it a neutral rating, because let's give the company some time so that we develop a proper kind of a trend. Valuations, very attractive compared to its hospital peers. And outlook, of course, a lot of things company needs to do, but it'll take some time. So on that basis, I've given a neutral rating, and net I've given 3.5 out of 8 for Park Medi World. and that is at an average, we could say an average number or slight below average number in our KYC show. So that is very much important. But joining us, we are joined by Dr. Sanjay Sharma, and he's the whole-time director and group CEO at Park Medi World. Very good afternoon to you and season's greetings to you, sir, to you and your entire team at Park Medi World. But first question, of course, is most importantly, we have started doing acquisitions a lot. I was reading about you, 55% of the revenue comes from acquisitions. What is this mindset? And if you have to acquire a company, which areas would you be looking at?
Good afternoon, Mr. Dubey, and good afternoon to your viewers. And thank you so much for inviting us to your channel to this thing. And it's an honor to speak to you. See, you are right. Out of 15 hospitals which we have, and the presence in 5 states, 10 of them are acquired brownfield projects, and 5 are greenfield projects.
All right, Mr. Sharma, apart from this, there was a recent acquisition coming in, 51 crores of acquisition. You just announced some days ago, but I was just seeing the margin profile. Is it actually on the lower side? And why did you actually do this acquisition then?
See, we have done 2 acquisitions recently. One has been the one which you're talking about is Fibris, which we are doing in New Delhi, which is a 200 bedded hospital which we have acquired in 51 crores. This is through IBC. This was an NCLT and we have acquired through IBC. And there is, as per the FAR, there is still a possibility to make it to 275 bedded hospital. And this we have already acquired. We have informed the stock exchanges and the regulators also on 24th of December about this acquisition. And everything, share transfer and all that, and ROC will happen by 31st of December. And we intend starting this in FY27.
All right, and Mr. Sharma, I'm just seeing the return ratios, the margins, not the margins front, just the return ratios, that has been under pressure. Is it because of, you are expanding very fast, and will we see these numbers muted in the next 6 months, 12 odd months? Because these things take time, the way you are approaching. So can you just give me some flavor on that?
Yeah, we have been expanding exponentially on our own. In fact, we have been going ahead annually. We are acquiring our greenfield projects. We've been starting 3 units in a year, roughly. And now with the IPO proceeds, probably we'll be going much faster. The dip which you were mentioning initially, in fact, we had acquired 1,000 beds in past 1.5 years. And that is the reason why this has been there. And that was entirely from internal accrual. The other thing which I wanted to mention that besides Fibris, we have also acquired 360 bedded hospital in densely populated heart of Agra. It's a 360 bedded hospital known by KPIMS, which has already been, agreement has been signed. And we will be inaugurating it on 15th of February.
That's a pretty interesting take on that. But Mr. Sharma, just to put in perspective, because a lot of concerns have come in from investors that, the company is expanding very fast.
Right.
What are the risks involved in it? And will there be any kind of fundraise in the offing? Because mathematically speaking, if you keep on acquiring, there must be some fundraise also, because I saw the cash balance also lower side. Expecting a 6 month in 12 month, another fundraise?
Mr. Dubey, just to give you a little insight, last year, this FY25, our EBITDA was 372 crores, and the cash flow from that was about 275 crores. So we are a cash-rich company. We have been doing profitability from past 21 years. In fact, we have 3 verticals which we follow in that aspect. One is the main vision, which is affordability. The second is high quality, and third is profitability. Based on that, we have been following it. And till now, with 15 hospitals, we have been EBITDA positive to the tune of about 27%. And our PAT has also been around 17% in that. So we've been doing fairly well, despite our fast acquisition exponentially every year in that.
Right, but Mr. Sharma, just to understand the capital allocation policy also, are you looking at any fundraise now in the next 6 months to 12 months? Because the way you are growing, it seems like it might be needed.
No, not at all, sir.
Not at all.
fact, till now, what we had totally spent on these projects was about 1,200 crores. And out of that, our debt has been only 425 crores. And we have roughly about 305 crores of FDs against it, which are unencumbered. And besides that, we have 40 crores in our current balance also. So practically, we have been debt-free company when we approached the approach for IPO, and we are cash-rich company in that aspect. And also with the IPO proceeds, 380 crore will be used for retiring the debt. 88 crores will be used for capex and the other Rohtak projects, and 302 crores will be used for
Yes.
general corporate purpose in
Yes.
that.
Yes, Mr. Sharma, now let's talk about the guidances. I want to start with the operational front, the average revenue per bed, the bed addition. If you could just give us any kind of outlook on the operational front, the occupancies, what are you expecting in H2 and maybe in the next 12 months?
Okay. Currently, we are about 68% plus occupancy, but that has largely been because of the 1,000 beds which we had acquired in past 1.5 years. Before that, if we reduce those 1,000 beds, our occupancy was somewhere around 76, 77% on a console basis. But going ahead, as the bed addition will happen, currently we are at 3250. Along with Agra, we will become 3610. And in this financial year, we are adding one more greenfield project, which is 300 beds from Panchkula. So that will take our tally to 660 being added in this financial year. The coming financial year, in FY27, we'll add 750 bed, out of which Kanpur will be a brownfield project. Delhi Fibris will be added, which is again a brownfield project, and Rohtak, which is a greenfield project, will be added into it.
And,
In
yes,
FY28,
Mr. Sharma, another query is Park Medicity. It seems like it's like a very, like a signature project of your company. Give us the timelines about it. Investors want to know what are the timelines of completion, etc.
okay. So what we are looking at, if I can just read it through, Agra we are inaugurating on 15th of February, this February 26th. Panchkula will be starting on 1st March 2026. Kanpur Brownfield again May 26, and Delhi Febris we are starting in August 26. Rohtak we are starting in January 27, so that takes care of the FY27. FY28 we are adding another 600 beds. So Gorakhpur 400 bed will be starting in April 27, and Ambala we a cancer dedicated unit along with our current hospital will be starting on October 27, which will be 200 bed. So overall, our bed strength will go to 5,260 by FY28.
All right. So just to give the entire view to our viewers, the bed occupancy levels are around at 68%, and the management has stated that the operational bed will go past that 4,500, 5,000 mark. Currently, it's at 3,050. Average revenue per bed is roughly 27,105. This number is also going to go up, or will it be same levels?
See, the aspect is this, since our primary goal, our vision has been affordability. So we are not looking at profitability coming from RPOP majorly. This RPOP would definitely grow, and we are looking in FY27 this RPOP to go around 32, 33,000. But we still look at the RPOP being around maximum 35,000 or so, because otherwise, if we go to 50,000 or 60,000, then we go from the affordability segment. As globally, if we see, the entire healthcare is divided into two major segments. One is the premium segment, which is 8, 9, 10%, and rest is 90% of the population comes in the affordable segment. Most of the other listed peers are catering in that 9, 10% of the premium segment. We are the only one which is structured, formatted, which is going for the 90% of the population, which is in the affordable segment.
That's pretty much interesting, and maybe that's why the street is giving a different evaluation to you versus the other hospital players, and that's what we got to know from the management as well. But there's another query, and this is not related to the markets, but I need to ask, in the NCR region, a lot of air pollution is there, and of course, you must be getting a lot of cases, you must be hearing it from your doctors. What's your view on that? Like, what's the current situation right now?
The air pollution in the metros and especially Delhi is not very good, as you rightly stated. And thus, a lot of COPD, these are chronic obstructive pulmonary diseases. These are major problems which have been coming to our hospitals, which is right.
All right. Thank you very much, Mr. Sharma, for taking out your time, giving the views for the company and clearing a lot of doubts as where the company is actually positioned and what the future will be there. But that's all. We spoke about the management and we gave you the entire picture of where Park Medi World is currently standing and where it will go in the future. So that's all, folks, for today. For KYC, stay tuned to NDTV Profit.